and welcome to this session of FTT on the topic of the changing face of FX risk management. There have been lots of changes in recent years when it comes to FX execution, new markets, products, increased use of tech. But what does this actually mean when it comes to managing FX risks? Do these developments mean that corporates could, should, or must change the ways that they think about foreign exchange risk? Before we get started on this conversation today, some housekeeping. Everyone's very familiar with the virtual platform, so please do ask questions as we go along by the Q&A box, and we'll try and answer as many of those as we can in the next 45 minutes. Also a reminder, the session will be recorded and available to watch on this platform for 14 days after the event. Right, let's get started with some introductions. I'm Sarah Boyce, and after many years of working in corporate treasury, I now provide policy and technical support here at the ACT. And for those of you who are very observant, you'll notice that we are not joined today by Ben Waters, who unfortunately has a family emergency, but Lisa Dukes, who is Director of Corporate Finance and Derivatives at Drax, has very kindly stepped into the breach at the very last minute. So we're going to, well, actually, we're probably not going to go easy on her at all, but anyway, very pleased to have her here. And I'm also joined by somebody who I hope will become a very familiar face, as we've already had a number of very interesting conversations between us. And that's Eric Hutman, who is CEO of Miltech FX. Let's start with you, Eric. Perhaps, as you are more of a stranger to the audience than Lisa will be, perhaps you'd like to introduce yourself and your organisation.
Certainly. Thank you, Sarah, for that introduction, and nice to speak to you as well, Lisa, today, and thank you all for joining us. As Sarah mentioned, I'm CEO of Miltech FX by Millennium Global. Millennium is one of the largest independent FX investment management firms in the world, with over $20 billion in assets under management. And Miltech FX is the fintech arm of that Millennium Group that offers a comparative multi-bank FX marketplace for corporates as well as also for asset managers. I personally have had my entire career in FX. I started my career as an FX options trader for HSBC before then joining Millennium as a portfolio manager and then launching Miltech FX a couple of years ago. So very happy to be speaking to you all today. I think, Sarah, you're on mute. Our friends can't hear you.
Yeah. Sorry, you'd have thought after 18 months, 2 years, I'd have mastered the art, really, but there you go. Sorry about that. So, Lisa, perhaps you'd like to introduce yourself.
Yeah, sure. Morning, everyone. So I've spent over 13 years at Drax working across all aspects of treasury, corporate finance, and financial risk management, dealing with unique and complex economic exposures through many different change cycles. My current focus, particularly over the last 5 years, has been structuring innovative new solutions across the full treasury and corporate finance space, considering multifaceted and often competing factors to deliver balanced, holistic solutions to a variety of different challenges. I'm also a member of the Bank of England's FX committee, hopefully offering up a corporate voice in a room traditionally not filled with corporate voices, and I'm an advocate of the FX Global Code of Conduct.
That's very comprehensive, and makes you sound like a bit of a grown-up, which indeed I know you are. Now, Eric allegedly. Is allegedly, yes, sources say. Yeah, I know that Eric is going to spend a few minutes taking us through the recent developments in the FX markets and some of the things that corporate treasurers should be thinking about in relation to those markets. Perhaps, Lisa, you could just kick us off by talking a little bit about how you approach the topic of FX risk management and what sort of problems that you're actually looking to address with FX risk management. A little bit of just a refresher for those people who have probably parked FX risk management for the last couple of years and could probably do with, well, there's too many probablys in that sentence, but could do with bringing it out of the cupboard and giving it a bit of a refresh.
Sure. So the foundation of our hedging approach is continual challenge and review. Any policy, FX or others, is just an expression of risk appetite at a set point of time. And without review and challenging the policy, it's at risk of being outdated with regards to the market dynamics, changing exposures, or perhaps even company strategy. So it's important to understand what the acceptable and unacceptable risks are within that set risk appetite. So a regular review cycle is really critical. As an illustration, through recent market volatility, we approached the board with a paper highlighting that if following the set policy blindly locked in a loss, it was likely increasing risk rather than reducing it. And the fundamental principles of hedging is to lock in a positive spread or a positive margin would be diminished or eroded. So in practical terms, that means we structure to have a policy framework and where the application can then be flexed in light of the changes across a number of areas, including the existing business needs, any growth aspirations, either organic or through M&A, and as a result, any implications or potential future exposures, the underlying market rates, including spot and forward curves, but also volatility curves where options are concerned, and the overall credit profile of the group and quite wider credit uses. So in short, we don't consider the use of derivatives as a mechanism to purely secure a P&L rate, but instead a tool that provides a corridor of P&L certainty, unlocking value whilst hedging in the most credit efficient manner possible. So our focus is on protecting and creating value within the portfolio, which we do through managing 3 key risks. And each risk may be more prevalent in some businesses than others, and it's very key to tailor the approach against the policy. The first key risk would be managing the spot risk, and for us and for many, that will be and will remain the biggest risk as it drives the majority of the P&L volatility. Drax are buyers of US dollars and therefore are exposed to sterling weakening, and securing that worst case protection to the policy minimum is key for any policy. And we do that through use of both options and forwards, and actively manage the execution of the next trade to target better rates than are available to lock in today. We have a longer dated exposure profile. We actually hedge out for 5 to 6 years, looking at both committed and forecast transactions. So we're heavily exposed to the forward curve. The cable or the sterling dollar curve historically has been negative, but in the last few years, the curve has been significantly positive. So for example, the 6-year curve, not too long ago, although probably longer than I'd like to imagine, was it hit 12 cents. So we work with banks and developed bespoke solutions to hedge the interest rate differentials while still being agnostic to the spot. And that's enabled us to capture that value and reduce the risk of it reverting to a negative kind of curve where actually the 2-year points are today. It's worth saying that the ideal entry point for spot and forward points are typically negatively correlated. And by managing those risks separately, we can and have actually captured substantial additional value. The third risk, and I really need to come up with a better name for it, but we call it the ability to hedge or credit risk. In our case, where sterling strengthens, that's very good for the underlying business and future hedging, but it's not so good for the mark-to-market of the existing portfolio. If rates move significantly, credit lines may become under stress, and the ability to add in new hedges at the very time that we're looking to add new hedges into the portfolio may be impacted. And that's never a great message for the board or any of our stakeholders. So we can use derivatives to limit or to cap the credit line exposures. And that does a few things. It creates a very positive dialogue with banks' risk committees for one, but importantly, it also enables participation into our wider portfolio, enabling us to increase the worst case rates that are in place at the moment. And with cable currently lower where it is today, it's an ideal opportunity to layer in that protection. Interestingly, we've done a lot of work with banks and other corporates to explore how to implement this type of approach, given their different exposures, differing market risks and risk appetites, and something which may be evident that I'm fairly interested in.
Yeah, I think you're clearly very, very interested in this topic. you are the perfect person to have on the conversation, I think. But at the risk of us going completely off track, because watching Eric's face, I think we could have a whole conversation just on what you said in the last 5 minutes, Lisa. Let's try and stick to script, just at least to start with. And perhaps, Eric, you could bring us back to talking us a little bit about the developments that we're seeing in the market at the moment, and how that might impact on what treasurers might want to think about. And then I suspect we should just circle back to what Lisa's been talking about and discuss.
Certainly.
Anyway.
That sounds good to me. I'll share my screen at this point, and hopefully this all comes through for everyone. Sarah, perhaps you could let me know if that's come up.
Yeah, I can see it. Thank you.
Say again, sorry.
Yeah, yes, that would be great.
Has that come up?
Yes. Yep, I can see that. Yep.
Very good. Hold on a second. Let me just get this. So very good. Super. Well, thanks very much. One of the highlights I wanted to describe to you today was on both the market context of what's going on in currencies and what's going on in the sort of macro outlook, as well as also look at some of the things which we think treasurers should be keeping in mind as they go into next year. And as I mentioned, Miltech FX is part of the Millennium Global Group, and Millennium offers investment management services, and our economics and strategy team have general thoughts that they put together on a quarterly basis that go out to the market. And so I thought I'd summarize a few things for you here that have come from their research. And specifically, if we start with sort of the general currency environment that the team looks at, in a sense, at the moment, the view is essentially quite dollar bullish, with as they look at specifically interest rate differentials and the evolution of those interest rate differentials compared to what's priced in by the market in terms of central bank policy. There's a general view that certainly over the next quarter or so, there'll be a continued dollar appreciation potential, specifically against the likes of the Japanese yen, as well as the Swiss franc, and especially against the euro. And sort of to break that down a little bit, I'll go into some of the economic side in a moment. But in the US, there's very likely going to be the next interest rate hike in later this year, the pace of tapering likely accelerating in December before raising rates in June, I should say. But the interest rate curve that's being priced is likely has more to go, according to our team of economists, etc., which really underpins the support for the dollar, the view that they've got against those currencies, which is a little bit in the basket of pro-risk as well. So if we think of other currencies like the Canadian dollar and the Australian dollar, for slightly idiosyncratic reasons, are also have a positive view on. And from a Canadian perspective, it's linked more towards labour market slack continuing to shrink there, with an expectation of hawkishness from the Bank of Canada continuing in view of upside risk on the inflationary side. And it's also fundamentally a cheap currency, as is sterling, which we might talk about a little bit later. In terms of the Australian dollar, it's also a little bit of a case of balance of payments and underlying fundamental story being supportive of the Australian dollar within a pro-risk environment, but slightly balanced by the fact that the US dollar is expected to be stronger as well by the team. But if I think predominantly about the euro, I think what's interesting, and we can talk about volatility, which Lisa mentioned earlier, and the return perhaps of volatility. I think we're starting to see a period of central bank divergence, and I think in the Eurozone, the ECB's tone compared to that of the Federal Reserve in the US has been quite markedly different. And in the Eurozone specifically, where we've seen, yes, an increase in cases of COVID, but also a downside risk on the economic side, and potentially a greater transitory effect of inflation as opposed to more structural inflation in places like the US sort of lead the team to believe that the ECB will be further behind the curve than the Fed in terms of hiking, which definitely supports their view of bullish the dollar against the euro. If I look sort of more from a global growth standpoint, the economics team generally remains optimistic around global growth, and though believes that supply side challenges will persist to a degree, but there's been a gradual rebuilding of inventories over quarters, and final consumer demand remaining quite resilient. And if we think about the labor market dynamics, they've, in our view, have responded relatively well to the reopening of developed markets in most cases, although slack does still remain and unemployment is still above pre-COVID levels. Forecasts, OECD, if you look on this side of the chart, according to the OECD, forecasts of unemployment will continue to sort of move back towards where we were from a pre-COVID basis towards the end of next year. And even in places like Australia, where lockdowns have been very persistent, this is likely only going to be a temporary setback in the view of the economics team. And within that context, as you can see on the chart on the right, the vaccination rates in general have been relatively strong, with parts of the euro area perhaps being at odds with that. And we're seeing already, as you all will know, parts of the Eurozone locking down again, especially places like Austria, etc. But overall, the picture is one of relative positiveness from a global context, especially supporting the labor market and underpinning certain inflationary pressures, especially in the US. And so if we look at on that side of things now, there's been obviously a very material increase in inflationary pressures recently. Some of it can be considered temporary, and supply chain disruptions are likely to persist over the next couple of quarters. So it will take time for those sort of supply chain related inflationary pressures to dissipate into the end of next year. And the team believes that the CPI surge, the inflationary surge, is really, it's not just a supply side issue, but also a demand story, with pent-up demand increasing house prices, bottlenecks and labor shortages in specific sectors also point to rises in core inflation. So core, if you extract things like energy, etc. And if I come back to the underlying view of central bank pricing, there's definitely a view by the team that there's an underpricing in the market of hikes, of central bank hikes in the US compared to other places, when combined with that view of persistent inflationary pressures underpins their view for a bullish dollar environment. And if you look on the euro side, which is on this side of the page, the right-hand chart, specifically the ECB continues to reiterate that the current increase in inflation will be temporary, as rising energy prices are one of the driving reasons for the rise in CPI that they've seen there. And as a result, if you look at the sort of the wages and inflation expectations, they're still below the target of the central bank. So interesting diversion, I think, that's being seen, and we've seen already this month quite a material a rally in the dollar, which and also a rise in volatility. And in general, when you've got diverging central bank policies, it sets itself up for likely potentially increases in volatility across FX as a whole. And there's implications of that from a treasury perspective as well, which we can talk about. So I'm happy to take further questions on this topic. Go ahead, Sarah.
Yeah, so sorry, I was just very quickly going to ask. So we've got this divergence, particularly between the US and the Euro central banks. Where does the Bank of England sit in this? What about sterling? Is it in the middle of this chart, or is it somewhere else completely?
So sterling is a little bit different in the sense that the Bank of England is likely going to be the first central bank out of these three to be hiking rates, and there's an initial 15 basis point hike that's essentially fully priced for December, so next month's meeting. The difference between the two as it relates to the currency is the market was very quick to price in central bank hikes in the UK. So in the view of our economics team, hikes are going to materialize essentially by 125 basis point hike per quarter next year by the Bank of England. But that's already a base case that's in effect priced in for the market. So the view of the team from a sterling perspective is bearish against the dollar because of the dollar lens, but it's a bit more nuanced versus the euro. And especially into next year, at the moment, there's potentially some tactical sterling weakness, but into next year, perhaps it's likely that there could be some sterling strength, especially against the euro, and even against the dollar towards the end of next year, once the central bank pricing has aligned more.
Thanks. That's really helpful to understand.
Thanks, Eric. If I sort of move on to think of some of the key themes for treasurers to think about, and it's something that we consider a lot. One of our large client bases are in the corporate section, and as we've been talking to them recently, a few things have come up, and it resonates, I think, with Lisa's comments earlier. And the crucial first step is, I think, gaining visibility on where those currency risks lie within the organization, but also going through that continual process of reassessment. This is not a static. It's not as though you do it once and then we can forget about it, although that would be helpful, given that for all of us here, FX is a second order effect. Foreign exchange is not the core activity of our group here. It's almost by definition second order. And I think what's interesting is not only as a result of how the business needs change, but also how, as a result of how the market's changing, there is that continual need for reassessment, which I agree with Lisa on completely. But I think if I look holistically, over the past couple of years, it's been a bit difficult to get that strong visibility. And there's some research that has come out recently from both HSBC and PwC saying earnings have suffered from unhedged FX risk as a result of being potentially the challenging environment of quantifying what was actually the FX exposure, given the difficulties that businesses had during COVID. And I think that if we extend that, gauging the impact of a potential rise in volatility, not necessarily as it relates to whether or not you should use options, because obviously volatility is an integral part of option pricing, but it's more about what are the liquidity and funding requirements that occur should volatility rise beyond the sort of relatively low vol levels that we've seen previously. And I think that can impact both also the risk tolerance, the risk appetite to either hedge or not hedge, and anything in the middle. And I think we can also talk about that this doesn't have to be a binary decision, either hedge fully or not hedge at all. And there might be instances where hedge ratios can and should be changed and altered throughout that period. And I think that those concerns only get amplified in an environment of rising volatility, as also do potentially margin concerns. And this won't necessarily apply to everyone here, but for some corporates and organizations who do have to post margin, either initial margin or variation margin for derivatives, it doesn't have to be just for a simple FX forward. It could also be for a non-deliverable forward or an FX option. The cash drag from posting margin, if you've got a rise in volatility and you've got asset liability mismatches, which I think was also one of the things that Lisa mentioned, should be taken into account. And as a result, therefore, it's really that risk appetite that should drive hedging decisions in our view. And that is something that can be iterated and continued, and also doesn't have to be static, as we mentioned. So if we think about looking into next year, one of the sort of three key areas that we've been talking to with our clients has been along these pillars. So it's around automation and digitization, it's around outsourcing, and it's around transparency. And one of the elements that we've been talking about with our client base is trying to add cloud-based tools to digitize and automate the FX process. And that's not just the execution process. And I think there's been a relatively significant rise in the use of electronic trading, especially at the highly sophisticated end of the corporate spectrum. But I think that there still is room for a greater adoption of, for example, comparative FX in the more medium size of the market. But also it's around integrating into treasury management systems and into post-trade systems to create a system which is fully digitized without breaks that basically improve efficiency and reduce cost. And that's a key trend that we think will only continue, has already started, but will continue. The other area that we're seeing is an increased use of outsourcing. And what I don't mean here is outsourcing entire functions, but it's outsourcing specific pieces, especially for non-core activities, which can be a nuisance. And we've seen research from HSBC recently that there's been an increase in outsourcing of certain day-to-day functions, which can be a drag on overall productivity. And we certainly see that with our client base as well. And then finally, looking at transparency, which is achieved hopefully not just by ensuring best execution through the actual tools that people use to execute, but also evidenced with independent transaction cost analysis. And what we've seen with our client base is a relatively wide variety of clients who've either never had TCA done before, or those who've done it as a test, but and then some who do it on a very regular basis. And I think a more broad adoption of transaction cost analysis, which can act as an independent audit into the quality of execution, is something which will continue. And then finally, if I think about ESG, and I'm very glad to have Lisa on this call because she frankly will have has a lot more experience, I think, in this than I do. But how ESG can be applied to FX is interesting. And as we all know, it's an increasing focus to many treasurers and many organizations. And ESG-linked FX derivatives are now starting to be tested. And I believe Drax was one of the first to do that in the industry. And I won't put words in Lisa's mouth, but I'll let Lisa talk about that later perhaps. But we're seeing an increased demand from our client base on this. And actually, it's not just from the ESG-linked FX derivative side, but it's also about, can FX execution itself become sustainable? And we've been doing a lot of some work with our banks to try and quantify the carbon cost of our FX activity mechanically. And this is sort of early stages of that, but trying to quantify how sustainable an FX execution platform can be is sort of some of the things that we're looking at. But what can be done now, in terms of, I think when we think of ESG, sometimes the G gets forgotten about, but having strong governance around best execution with transaction cost analysis can really very easily help improve the G, help improve governance around that framework. And we've seen that being a very strong impetus for our clients, especially those who are publicly listed, who've got an external impulse to become more transparent and add to their ESG framework. So I'm very happy to leave it there, Sarah, and we can open up to a discussion between us.
Yeah, no, I think that's really helpful. Thank you very much. And very, very, very interesting. I think that perhaps we'll just go to a few more specific questions, but there is a number already coming through actually from the audience, and I'll feed those in as well. But if we just take half a step back, Eric, and you were talking about automation and digitization. I guess this is probably a question more for Lisa. To what extent do you rely on the growing automation and use of technology within your treasury function, particularly when you're thinking about FX risk management?
So for me,
is it something that
technology,
you're driven by the tech, or?
No, for me, technology is just an enabler to support me doing my job. So optimizing and using the right technology is for the right tasks is part of how we manage risks. We do use platforms and other technologies, but by far the majority of what we do to manage the risk is bilateral and talking to people and building long-term relationships has significant value, and that shouldn't be underestimated.
And if I can jump in, I completely agree with that. And I think especially when we come back to what we said earlier, is FX being a second order effect to the underlying goal of a business. Technology shouldn't be used for because it happens to be the most, I don't know, in vogue thing at the moment. It has to be done to hopefully make things either easier, faster, cheaper, or all three, and is not a substitute for the relationship building that Lisa mentions, as well as the the overall interpersonal necessary relationships that are needed for the policies to be set in the first place. Tech is the tool rather than the input.
That's great, thank you. There's a question coming here, Eric, that touches back on outsourcing, but probably also leads us forward into a wider conversation. So I'll just read it to you. So you mentioned an increase in outsourcing of some aspect functions. If options are used as part of the risk management arsenal, what considerations should treasurers have to help optimize their approach and best manage their resource? So I guess it's how do you, particularly if you're doing options or generally speaking more complex products, what sorts of things do treasurers need to think about particularly, perhaps?
So I think in general, it comes from the discussions that we've had with our clients. It's around what is actually being solved for here. And I think that sometimes we've had discussions with clients who come into it wanting to have an outsourced solution for a relatively complex structured product, for example. But actually, when it's brought back to what is the utility function here, what's the underlying goal, actually the output might be different than what was originally sought out. So I think my overall reaction to that is I wouldn't get blindsided by the potential complexity of the instrument when thinking about what is the instrument trying to achieve. And I think that when thinking about that in the context of outsourcers who don't set the hedging policy and the risk appetite, that's you, the client, who sets the hedge. That communication is critical, because the outsourcer might be able to provide you with a product, but it might not fit into your requirements. So thinking about how those products fit into those requirements, I think for me is the first step that's critical. And the collaboration with the outsourcer in doing that is critical. And it might lead to a different outcome in terms of the instrument used.
That's really helpful, thank you. And another question that's been asked, quite a popular question. Lisa, you might want to take this one first, and then perhaps Eric, you can comment as well. But basically, it's a question about whether or not treasurers should really start to consider using more complex either products or actually hedging programs in the light of market evolution, shall we say. Lisa, I don't know if you've got any thoughts on that. Traditionally, I was in a corporate back in the day. 80% plus of what we did would be spot or forward, and that was pretty much it. Have things moved on a long way? Should they be moving on a long way?
I think particularly with the market dynamics we've seen over the last year or so, the changes in the market and the changes of the products that are available, sometimes they are referred to as complex, but ultimately they are vanilla products. And using all of the tools that are available to you to create risk-adjusted value in the portfolio as a whole, managing all the risks in entirety, shouldn't be discounted, and they are there to be used and are appropriate in different scenarios.
And I think if I could add to that, there's potentially a difference perhaps between using more complicated products, so instruments, so do you use options versus just a forward, and having a slightly more advanced or complicated, I should say, policy implementation process. And what I mean by that is, and this comes back to the point of should you always be either not hedged or fully hedged? And how can you be in the middle? And actually what we're seeing is, and our sister company, the investment management side of Millennium deals with this, is currency overlay, is saying, okay, if you actually want FX to be not just a source of risk, but also potentially a source of added return, and Lisa's comment there of risk-adjusted value, I think perhaps fits into that, is we're seeing a number of clients actually looking at trying to overlay on top of their existing, call it passive hedging, standard 1 month rolling or 3 month rolling hedges, something which can perhaps deviate that hedge ratio according to some kind of input. And those inputs could be either systematic or could be discretionary. But it's using a tool to either help do it yourself or have a manager that does it for you, that can basically try and optimize when you're hedging. At what point should you be hedged? At what point should you be not hedged? And I think that fits into the conversation of more complicated strategies or instruments. They don't have to be complicated in terms of output, though. There are simple ways of doing it. And I think the goal is evolution versus the basic standpoint of spot and forwards usage.
I agree. There's a difference between complexity and being increasingly active, and
Agreed.
Often being increasingly active can create value and help manage all risks in a holistic sense, and understanding the risks that are accepted and unaccepted within your risk tolerances, and when the timing of the next hedge comes through, there is value in that, and time has value, and capturing that helps mitigate all risks.
Yeah, agreed.
Thank you for that. So just before we move on to ESG, and I do want to save a few minutes to talk about that, because we've got Lisa in the room, and Eric will have a view as well on ESG and FX. Just very quickly, are we finding corporates increasing or decreasing the time horizon that they're hedging over? And it ties into another question that's been asked, actually, which is about boards and whether or not they're becoming more or less risk averse. I don't know if there's a connection between the two, or whether or not, there isn't.
For me, understanding your whole exposure profile, regardless of the time of which you're focusing on, you may have FX exposure out forever, and just by focusing on a small window, you're then accepting those risks in the future. It doesn't mean that they're not there, and it doesn't mean that you're not going to hedge them. It's the timing at which you hedge. They will be hedged eventually. So having the flexibility to extend or look at those exposures in the right market scenario or in the right way using different products, I think is key. And I'm having conversations with fellow treasuries who are more open to that, and they're progressing that within their own businesses. So I think it's definitely something that people are talking about and are more open to, particularly over the last year, or probably more after Brexit and COVID, the market dynamics and being open to flexing. If we're just hedging because the policy says to hedge, that's not necessarily risk reducing, and challenging the policy and what that policy should look like should be where the conversation starts.
Yeah, I agree with that completely. And if I sort of add to it, we have a number of clients in the infrastructure space and that sort of thing. And I think that sometimes what has to be considered is, just because you know that you've got an exposure over, let's say, a very long horizon, let's say a 5, 10-year, 20-year horizon, that doesn't mean that the instruments that are used to mitigate that risk have to be of equal duration. And yes, and then you have to think about, okay, if I do have an asset liability mismatch in terms of the hedge duration versus the asset, which I'm using because it's more beneficial from a market dynamics perspective, how does that impact my policy? And so I think that from the conversations that I've had, it's not so much that FX risk is all of a sudden something new for boards, but I think that the degree of options available to manage those risks and do so in a transparent way and quantifiable way, I think has increased. So that perhaps sensitivity has increased.
Okay. No, thank you for that. So just very briefly in the last 5 minutes or so, let's touch back on to ESG, and we could probably spend another half an hour on this, but hey, we are where we are. So Lisa, let me start with you, because this is definitely your bag, and I've seen you write a number of articles and talk on a number of occasions about ESG FX derivatives. I guess there's a couple of very quick questions that I've got for you. And the first is, so what exactly is an ESG FX derivative? Because I can completely see how you can have an ESG link to your, or standards linked to your funding, but how do you do that with FX? And then the other question that I've got, also on ESG, is that it's the bigger ESG question, which is really about, are you really being asked about governance, or is ESG all about the E end of ESG? So I don't mind which way around you want to take those two, but that's my brain dump at you for the next 3 minutes.
Okay. So when speaking to banks generally, we see two types of approaches covering ESG derivatives. The first, more common, the single derivative transaction approach, which has been around the longest and has typically been associated with single transactions linked to use of proceeds or similar. Very project focused and can work well in a standalone project is greener than the rest of the business. There is a new one, which is the portfolio approach, which is now also gathering speed, which, while might not be viable for all businesses, it can be a more holistic approach to applying an ESG focus to the business. It can be implemented in many ways, either as an evergreen agreement with KPIs set and challenged regularly, or reviewed annually perhaps to make sure the ESG rigor is still appropriate. But it's still very company specific and can be applied to the ES and or G. While it is linked to the individual company's strategy, or perhaps even two-way building in the bank's ESG commitments as well. And the documentation is very simple. It can be documented as an is there amendment or side letter. We were keen to adopt the portfolio approach to more closely align to Drax's negative carbon ambitions, enabling us to tie our sustainability metrics to our day-to-day trading activity, but also to more closely align to the sustainability-linked agreements in our other treasury disciplines. As a whole, the banking group, and even wider actually, has been very supportive of the approach, and we've been working with more banks and signing up more derivatives since our first agreement. Now, the reduction in carbon intensity, or the E in ESG, is clearly very pertinent to Drax, and so it is the focus of our ESG-linked treasury agreements, which now cover debt, working capital, and now this multi-asset ESG derivative overlay. But we are reviewing other KPIs to accompany this established environmental one. The most obvious link in this space for me is with the FX Global Code of Conduct. For those of you who are not familiar, the code promotes best practice for all markets, or all FX market participants, and it's not just for the big buy and the big sell side names. Its application is intended to be tailored and proportionate to the nature of the participants' engagement with the market, as well as the type of activities and trading that they do, whether that's big multi-million trades or simple cash flow through FX offer, for example. We've signed up, and our risk parameters reference the code, which in my view is a valuable control framework for anyone, including corporate. It's not about a tick box governance exercise, but its focus is more on the overall governance ethos. I would encourage anyone to find out more, and I'm more than happy to share my experiences, and hopefully we can get more corporate signed up, because we're few and far between at the moment. But where FX is concerned, I think the G in ESG is the FX Global Code of Conduct.
Right. Eric, do you have anything to add on that particularly, or?
Yeah, I mean, look,
perhaps.
Go ahead.
I was going to say, or perhaps given I've just got half an eye on the clock here. Perhaps you want to fold that into any final thoughts that you might have on FX risk management and what treasurers need to be thinking about over the next few months.
Yeah, certainly. So look, from the ESG side, you know, the element that we're trying to look at as well, in addition to what Lisa mentioned, is trying to actually quantify the degree of carbon usage of the actual FX activity itself, which means looking across our own technology stack, looking across the banks that we deal with, looking at the different infrastructure partners that we've got, and trying to actually quantify to what is the carbon usage of the execution that's going on through our platform. And I think that there's a lot more that needs to be done in that space. And you know, as an organization, we're carbon neutral, but I think the activity itself can also become carbon neutral if we're all aligned on this. And I think that the market is very much moving in that direction. In terms of the G, Lisa mentioned, funnily enough, one of my board members, who's also called Lisa, was also on the Bank of England Joint Standing Committee representing our firm. And so we're obviously also, we were one of the first buy-side participants to sign up. Very much agree that acts as the key pillar of governance in FX. And I think that, but very, very mechanically, I think what a treasurer potentially could take away from that is you've got governance that you can implore at the best execution level, but you've also got transparency, which can be delivered via transaction cost analysis, TCA. And I think that that's a very easy, tangible first step into trying to increase governance around the actual execution piece is incorporating TCA. And that I think is something which can increase over the next year for sure.
And I think that we should definitely have another session to talk about TCA. Lisa, is there anything that you'd like to add before we close?
I'd just say, for me, risk management should be focused on understanding your business today, but also where it could be tomorrow, and standing ready to flex to whatever may come next. And I dread to think, to be honest. A very smart guy I know said at the start of 2020 that it's the known knowns or even the known unknowns that you need to consider, but the unknown unknowns that you need to plan for. And I don't think his wording could have been any more apt in advance of COVID. But that premise still holds true now, and we should be thinking about risk management in a more holistic way for all risks and wider risks, rather than just focusing solely on the near-term P&L certainty, which, whilst important, is only one aspect of the broader risk profile that treasurers have to manage, and not just hedging because that's what the policy says and has always said to do. I'm more than happy to take any follow-on questions after, as I'm conscious that we've only had a relatively short time to discuss. Thank you.
That's brilliant. Thank you both very much indeed. And we are well out of time now, so apologies for my very poor timekeeping today. Hopefully we've given everybody something to think about when it comes to considering FX risk management, particularly going into 2022. You know, it's the perfect opportunity to take half a step back, think about some of the big picture stuff that Eric and Lisa have touched on today. And as they say, we're all more than happy to follow up after this. Do also pay a visit to the discussion forum on the app and ask any questions there, and we'll make sure that they get back to Eric and Lisa. And please do just continue to listen and watch the rest of the festival. So finally, I'd just like to thank Eric very much indeed, and Lisa particularly for stepping in at the last minute. Thank you all, and enjoy the rest of the day. Goodbye.
Thank you, everyone. Thank you, Sarah. Thank you, Lisa.